Hello class, this is the chapter 7 video number 2. So voucher system. In a computerized system, data from the supporting documents such as purchase orders, receiving reports, and supplier invoices are entered directly into computer files. At the due date, the checks are automatically generated and mailed to creditors, and at that time, the voucher is electronically transferred to a paid voucher file. Cash paid by EFT. Cash can also be paid by electronic funds transfer. Examples include the following: a withdrawal of cash from a bank account using an ATM machine, a payment of wages or salaries, payroll check by an employer directly to an employee's checking account, a payment to a supplier or other vendor from a company. Bank accounts, again, a major reason that businesses use bank accounts is for internal controls. Some of the control advantages of using bank accounts are as follows. Bank accounts reduce the amount of cash on hand. Bank accounts provide an independent recording of cash transactions, reconciling the balance of the cash account in the company's records with the cash balances according to the bank is an important control. Use of bank accounts facilitates the transfer of funds using EFT systems. Bank statements. Banks maintain a record of all checking account transactions. A summary of all transactions, called a bank statement, is mailed usually each month to the company depositor or made available online. A bank statement shows the beginning balance, additions, deductions, and ending balances. So here's an example of a bank statement. This is the same one that's in your textbook. So here's a running account of it. The company's checking account balance in the bank records is a liability. Thus, the bank's records, the company's accounts, has a credit balance. Because the bank statement is prepared from the bank's point of view, a credit memo entry on the bank statement indicates an increase, a credit, to the company's account. Likewise, a debit memo entry on the bank statement indicates a decrease, a debit, in the company's account. A bank makes credit entries, issues credit memos for the following: deposits made by EFT, collections of notes receivable for the company, proceeds for a loan made to the company by the bank, interest earned on the company's account, correction, if any, of bank errors. A bank makes debit entries, issues debit memos for the following: payments made by electronic funds transfer, service charges, customer checks returned for not sufficient funds, correction of bank errors. So here's a checking account company and bank perspective. Here's the company side. Balance, debit increases asset, credit decreases the asset. So debit, credit. Here's the bank. So there's a liability company account, decreases in liability. Debit memo, we just went through that as examples, increases in liability, which will be a credit memo, and those are those examples we just went through as well. The following types of credit or debit memo entries are found on a bank statement: EC, error correction to correct bank error; NSF, not sufficient funds check; SC, service charge; ACH, automated clearinghouse entry for electronic funds transfer; MS, miscellaneous items such as collection of a note receivable on behalf of the company or receipt of a loan by the company from the bank. The cash balance shown by a bank statement is usually different from the company's cash balance. Differences between the company balance and the bank balance may arise because of the following: a delay by either the company or bank in recording transactions. The bank has debited or credited the company's account for transactions that the company will not know about until the bank statement is received. Errors such as an incorrect posting made by either the company or the bank. So here's an example. So one of them shows the bank statement says the ending balance is $3,359.78, but on the company, our company, for example, the book balance, ending balance is $2,549.99. So there's a difference in there, and some of them might be transactions that haven't been posted, or we haven't recorded them in our books, or we also might have a check that's in transit, meaning we paid a check or a bill with a check and it hasn't showed up, it hasn't cleared the bank yet. So those are a couple of examples. A bank reconciliation is an analysis of the items and amounts creating the difference between the cash balance reported in the bank statement and the balance of the cash account in the ledger. The adjusted cash balance determined in the bank reconciliation is reported on the balance sheet. A bank reconciliation is usually divided into two sections as follows. The bank section begins with the cash balance according to the bank statement and ends with the adjusted balance. The company section begins with the cash balance according to the company's records and ends with the adjusted balance. The adjusted balance from the bank and company sections must equal. The format of the bank reconciliation follows. As you can tell, balance according to the bank, add deposits not recorded, deduct outstanding checks not paid, and then there's our adjusted balance. On the other side, cash balance according to the company, add any credit memos that have not been recorded, and then deduct any memos that have not been recorded, NSF check service fees, and then there's the adjusted balance. So those two must equal. If they don't equal, we got to figure out what's going on, okay? Bank section of reconciliation. These are the steps. Step 1, enter the cash balance according to the bank from the ending cash balance according to the bank statement. The previous slide showed what happens visually. This is the actual wording of it. Step 2, add deposits not recorded by the bank. Identify deposits not recorded by the bank by comparing each deposit listed in the bank statement with unrecorded deposits appearing in the preceding period's reconciliation with the current period's deposit. Example, deposits in transit at the end of the period. Step 3, deduct outstanding checks that have not been paid by the bank. Identify outstanding checks by comparing paid checks with outstanding checks appearing on the preceding period's reconciliation and with recorded checks. Example, outstanding checks at the end of the period. Step 4, determine the adjusted balance by adding step 2 and deducting step 3. I know that's kind of confusing, but the image 2 slides back indicates what that looks like. Step 5, enter the cash balance according to company from the ending cash balance in the ledger. Step 6, add credit memos that have not been recorded. Identify the bank credit memos that have not been recorded by comparing the bank statement credit memos to entries in the journal. Example, a note receivable and interest that the bank has collected for the company. Step 7, deduct debit memos that have not been recorded. Identify the bank debit memos that have not been recorded by comparing the bank statement debit memos to entries in the journal. Example, customer not sufficient funds, NSF checks, bank service charges. Step 8, determine the adjusted balance by adding step 6 and deducting step 7. Verify that adjusted balances are equal, which is step 9. Verify that the adjusted balances determined in step 4 and 8 are equal. Okay. The bank statement shows a balance of $3,359.78 as of July 31. The cash balance in Power Network's ledger on the same date is $2,549.99. So here's what it will look like. The following reconciling items were identified. Check number 812, check number 878, check number 883 add those up, put those on there, total $1544.99. Okay, so our balance bank statement was $816. Okay, note receivable, 400 plus interest of $8 collected by bank not recorded on the journal as indicated. Credit memo 408. Customer, $300 returned by bank because NSF insufficient funds as indicated. Debit memo of $300. Bank service charge of $18 not recorded in the journal as indicated by debit memo of $18. In addition, check number 879 for $732.26 to Taylor Company on account was recorded in the company's journal as $723.26. So there was a typo, 732 and 723. So here's what this looks like. So this is on Power Network side. Balance, according to the bank, was $3,359.78. Add the deposit of $816.20. Now we deduct our outstanding checks of $1544, so we get $2,630.99. We go to the cash balance according to Power Network's books, $2549.99. Add interest collected by the bank of $408. Then we deduct that NSF check, the service fee for it, and then the error, the difference was $9. That totals $327. Add those, subtract $327, and we get $2,630.99. So those balance, so we are in balance, and that's exactly what you want, which is step 9 there. So whenever we record those adjustments on January 31, cash of $408, because then we have to put the cash into our ledger, and that will be notes receivable and interest revenue. So we're putting those in as revenue, which goes to the income statement. This cash will go to the balance sheet. Also, we have to reverse that Thomas Ivy paid. So we're putting this back into his account because his check didn't go through, and then that goes $18 in miscellaneous expense. Now, don't forget, this is being expensed to the income statement. And account payable, Taylor Co. for $9, and then total cash that we're pulling off of our books is $327. Okay, so those are the entries. The objective of reconciling bank accounts is to control cash by reconciling companies' records with the bank statement. In doing so, errors or misuse of cash may be detected. To enhance internal control, the bank reconciliation should be prepared by an employee who does not take part in or record cash transactions. Otherwise, mistakes may occur, and it is more likely that cash will be stolen or misapplied. Okay, so keep in mind those are separation of duties, and they're usually laid out in your accounting policies and procedures. If you went through any company, they usually have accounting policies and procedures. So here's another example. Balance per bank account, $14,500. Balance per company's record, $13,875. So we'll have to go through and see what we're gonna have to reconcile those two. Bank service charge, $75. Deposit in transit, $37.50. Checks from Dave NSF for $800. Outstanding checks. So once you see $800, you know there's gonna be some service charges attached to that. So $14,500, add deposits in transaction, $37,500 or $37.50, deduct $5,200, those are outstanding checks. So $14,500, add $37.50, take away $52.50, we get $13,000. Now on the company side, $13,875, NSF of $800, bank service fee or charge of $75, so deduct that from that, we get $13,000. Those equal each other, so we are in balance. We have reconciled, and we're good to move on. It is not practical for a business to write checks to pay small amounts for such items as postage, office supplies, or minor repairs. Thus, it is desirable to control such payments by using a special cash fund called a petty cash. Okay, that's just cash that's laying around in the till or the register or the bank vault, or a cash a little safe. A petty cash fund is established by estimating the amount of payments needed from the fund during a period such as a week or a month. A check is then written in cash for this amount. The money obtained from cashing the check is then given to an employee, called the petty cash custodian, who disperses monies from the fund as needed. The petty cash fund is normally replenished at periodic intervals when it is depleted or when it reaches a minimum amount. When a petty cash fund is replenished, the accounts debited are determined by summarizing the petty cash receipts. A check is then written for this amount payable to petty cash. There's an example. So we're creating a petty cash. We're putting money in a petty cash fund of $500. So we're pulling cash out of our cash account. So we're shifting it. Okay, so that's all that's saying. So at the end of August, there is $30 of petty cash on hand. The petty cash receipts for the following items: office supplies $380, postage $22, store supplies $35, miscellaneous admin expenses $30. Total is $467. So we'll hear in a bit. We'll take a look at how to debit and credit this right here. Oh, here it is. So 402 goes to office supplies, 35 store supplies, 30 admin expense, and then overage and shortage. So this one, so then these are all going to expenses. These are all going to the income statement, and our cash, we're taking that and we're deducting that from cash as well. Okay, because don't forget a debit and a credit. If it's a credit in cash, that means it's decreasing cash. Okay. Special purpose funds. Companies often use other cash funds for special needs such as payroll or travel expenses. Such funds are called special purpose funds. Cash is normally listed as the first asset in the current assets section of the balance sheet. A company may temporarily have excess cash. In such cases, the company normally invests in highly liquid investments in order to earn interest. These investments are called cash equivalents. Here's some examples. U.S. Treasury bills, notes issued by major corporations referred to as commercial paper, or money market funds. So here's what this looks like. Current asset cash and cash equivalents, 1816. Banks may require that companies maintain minimum cash balances in their bank accounts. Such a balance is called a compensating balance and is normally disclosed in notes to the financial statement. A compensating balance is often required by the bank as part of the loan agreement or line of credit. A line of credit is a pre-approved amount the bank is willing to lend to a customer upon request. Days cash on hand measures how long a company could survive if its sources of revenue were to decline significantly. Days cash on hand is calculated as follows: cash and short-term investments divided by daily cash operating expense. So it's just talking about this again. So here's an example. The following information is provided. Cash end year, operating expense, and it goes year 3, year 2, year 1. So the combination of 2 adds up to 7,149. The days, so whenever we look at it, divided by 365, 10.9, 65595. So those numbers we took right here, this divided by that, so we can survive 655 days without, I guess, with the amount of cash we have on hand. This one is 567, 718. Obviously, you want to survive longer with operating with the cash that you have on hand. So 718 at year 1 has the best rate, and the lowest would be 567. So you want this number to be higher, because that's saying that you can survive a longer amount of time with the cash amount that you have on hand. So that is the end of this Chapter 7 video. If you have questions, please email. Let me know how I can help you. I'm here to record videos and provide guidance. Thank you and have a good day.